Good morning, everybody, and welcome to this week's weekly analysis session for Monday, 2nd of November 2015. Apologies for everybody who logged in to watch the live session this morning. I was having a few computer glitches before actually starting the webinar, and it seems like those gremlins have come back to haunt me. So, in haste, I've chosen to cut short the webinar. Obviously, there's the lack of audio there, so I'm running a recording now, and I'll have this posted ASAP, so thanks for your patience. The disclaimer: the content of today's presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, nor particular needs. So before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances. You can pause the recording now and read this as your leisure. All right, the agenda, as always, we're going to go through and have a look at the portfolio management, any specific setups over the course of the last couple of weeks. You might remember since the end of August, with the market really dropping off the edge of the cliff, a huge spike in volatility, that it was going to take a significant number of weeks to establish the right sort of price action. And we're starting to see a few more setups starting to raise their head, which is a positive sign. And certainly market risk is improving, more so in the US rather than locally. So I'll do that. We'll also, today we can't have any Q&A because the session is totally being recorded and not run live. At this stage, the benchmarking model has us still in very high risk in the Australian market. We haven't been able to get up a full head of steam at this point in time, so we're still in very high market risk. Conversely, over in the US, the price action has been very, very strong of late, and as such is dragging that market risk indicator up into moderate risk territory. And as such, we are now able to apply an 80% market risk multiplier to our maximum VAR. So things improving in the US for the time being. So what does that mean? Well, it means that if we're splitting our capital between both those markets and we've got a maximum allowable drawdown of 15%, that means that we can allow, or we can allocate 7.5% of that value at risk to the Australian market, 7.5% allocated to the US market. So from the Australian point of view, or the Australian half of that portfolio, if you like, because we are in very high market risk still, we're getting close to high risk. In fact, we're right on 40 at this on the stochastic at this point in time, and we'll have a look at that. So we're very, very close to being in high market risk, which is a slight improvement from very high. But what it means is that we need to apply a 20% market risk multiplier to our 7.5%, and that means that we're allowed to have only 1.5% of our capital exposed as risk across that combined Australian US based portfolio. The US, however, we're in moderate market risk, so we're allowed to apply now an 80% market risk multiplier to half the allocated capital, so therefore half the maximum drawdown of 15, so half of that is 7.5. 80% of 7.5 leaves us with 6% maximum allowable value at risk across our US component of the portfolio. Just to recap, on Friday, Jeff and I sat down and talked about all things macro in the world, what was happening with interest rates in the Australian market in particular, Cup Day. A bit of an each-way bet at the moment as to whether or not we will get a reduction in interest rates. At this stage, probably less likely. However, we did have some news come out earlier in the week in terms of inflation, etc., and it just gives the RBA a little bit of room to perhaps sit on their hands for the time being and just wait and see, which is probably what's going to happen. Last week's educational session was on emotional pendulums, so understanding the role that emotion plays in your trading and investing, why it's important to have an awareness of what you're experiencing at any point along the way, from utter despair to absolute euphoria, what that might mean in terms of the way you're handling yourself in different market conditions, and it's important to understand that the roles that your emotions play. Psychology is a massive part of trading and investing, and anybody who chooses to neglect that impact, I think, is not being realistic. Watch this we'll have out as soon as we can after the recording of today's session. So let's go across now and have a look at our market risk indicators in Beyond Chart. So there we have our XJO at the moment, the ASX 200, and as you can see, since bottoming out at around about the 5,000 level, closing just below 5,000, we have started progressively to see much nicer price action with a series of higher troughs on the way through, which is always a good positive sign in terms of price action. The end of last week wasn't particularly promising, however. A couple of darker candles there. Certainly market trying to find some support around that 5,200 level. You'll see our longer term moving average. Prices come up to this level. It's certainly well and truly sloping downwards at the moment. Yet to be seen whether we're going to have enough momentum and enough push to the upward side to get some closes above that level. And certainly once we do close above that level, if we do, then what I would certainly be looking for is to see that longer term moving average acting as a level of support. That would be the most positive sign if we can get to that level. Certainly volatility is tapering off. Certainly the slope, as you can see, is declining. But still, probably the last week or so it's pretty much flat, that level of volatility, if you like. So not continuing to show a decrease. And that level of volatility there, it's a percentage-based level of volatility, it's showing at 1.37 at this point in time. You will see our market risk indicator is smack bang on 40 at this point. So we're still in very high risk at this stage, and we need to get a move above that before we see any changes. Let's go through and have a look at the US. You'll see there that the volatility down the bottom there, and I'll just move that out of the way. You can see 1.17%. So in terms of swings, etc., movement up and down, certainly still a lower level of volatility than the Australian market. So whilst the broader market is reducing in volatility a lot quicker than the Australian market, certainly stock-specific volatility in the US is still very high, and those of you who trade that market would understand that. You've only got to look at earnings, and stocks can move quite a significant way with earnings announcements or any price revenue forecasts, etc. Any announcements can certainly move stocks significantly one way or the other. You'll see the price action now. Our longer-term moving average, whilst it was sloping down, has nearly now really started to flatten out and is actually starting to move up a little bit. We've clearly broken through at that longer-term moving average, which is basically a sort of a bull market, bear market indicator, if you like. We've certainly challenged and now beaten this very dominant bearish candle from back in August. And again, the price action speaking for itself, series of higher troughs, higher peaks right throughout. Looking fairly strong at this point in time. Certainly we're not back at the highs we were before August, but moving in the right direction for the time being. And as a result, market risk deteriorating or improving to the more positive side of the ledger. In terms of setups this week, there are a couple in the Australian market, so let's go through and have a look at those now. The first one in no particular order, UXC. So what we need to do again is just make sure that we've got the right sort of price action. So by that, as we know, the last trough coming in at or above the second from last medium term peak. So that second last medium term peak, not this one, the one down here. Where is the trough in relation to that? Well, it's clearly well above that level, so exhibiting good strong price action. All we need to do is go out and check where we are in the broader scheme of things. And you'll see that there's certainly some points of supply through here, which price is now trading above that level. It's had a bit of a retracement. It just needs to find a little bit of strength to break that last point of supply, that last medium-term peak. In terms of where have we been in history, well, certainly there's some levels there, some major long-term peaks back at around about $2.50 thereabouts. So certainly plenty of upward movement, if you like, that this stock can go through before reaching that fairly dominant peak. So certainly at least 2-1 on that particular stock in terms of a target. So that's certainly fitting the bill and ticking all the boxes in terms of a well-structured trade. So all we need to do now is place an on-stop order, a level above the last medium-term peak. Now, you might remember that we used to use 2 pips, and we've changed that because it's fairly arbitrary. 2 pips really means nothing when you're dealing with stocks of $50, $500, $1,000, etc. that we're going to get, particularly when trading in the US as well. So our rule that we've changed, not a huge change, we're now placing on-stop orders 0.5% above that last medium-term peak. So for this particular trade, that means we have an on-stop order coming in at $1.34 with a limit to $1.34.5. We have a protective stop outside of 2 ATRs and at least 0.5% below that last medium-term trough, and that has a protective stop at $1.14. That means that we've got around about a 20-cent risk on this trade, which represents around about a 15% a distance, if you like, from entry to our protective stop. Now that's getting out to around about 3 ATRs, which is nothing in of itself. We generally try and keep our risk on the trades around about that 10% level. However, if you do choose to take a trade like this, just be aware that it just needs to do a little bit more work to get to its first target. And that's just symptomatic of the volatility of this stock. So how much it moves on a daily basis tend to perhaps move a little bit more than some of the other stocks. So whilst it needs to do a little bit more work, because it is actually a little bit more volatile, the chances of it getting to its first target are probably pretty reasonable in any case. So that's UXC. Next one on the list. So let's just zoom in on this one. TPM, which is TPG Telecom Limited. So first and foremost, whereabouts are we in terms of price history? If we zoom out, you'll see that we are at all-time highs. So all the way through every one of these new peaks, it's always been at all-time highs. A lot of people say, oh, don't buy things at all-time highs. Look how far it can fall. Well, certainly this has been establishing a number of all-time highs and continues to move onwards and upwards. And the relative strength of this has been well established for a long period of time. In terms of the price action, that last trough that's now been created by virtue of a newly created short-term uptrend, that trough, where is that in relation to the second from last medium-term peak? It's well clear of that, so we've got very good price action. Now, typically, as mentioned, we would place an on-stop order 0.5% above our last medium-term peak. Well, our last candle there is actually moved more than 0.5% above that last medium-term peak. So what do we do? Does it matter that the trade has partially broken that last medium-term peak? Well, I don't think it does matter as long as we can still provide a nicely structured trade structure. I've said that twice, but a well-structured trade, because at this point in time, if we think that this last candle, that's the one that's just broken past that last medium-term peak, and the high of that last candle there you can see is $11.14. So if we're going to enter this trade, well, we still need to place an on-stop order. We still want to see that this stock is going to have sufficient momentum, sufficient energy to keep moving in an upwards direction. So the on-stop order, we're still going to place it 0.5% above that candle high, so 0.5% above that $11.14. So the on-stop order now is going to come in at $11.19 with a limit 0.5% above that level to $11.25. So we're still providing that window that we want the trade to trigger in. The protective stop, by virtue of its ATR, its average true range, the level of volatility that means, it's telling us that we still need to have a protective stop down at $10.04. So that's well below that last medium-term trough, so that's a good thing, hiding below that level and also using that volatility as a measure to make sure that we're outside that danger zone, if you like. It still presents quite a nice structure on the trade. So those of you who want to take that trade, that's absolutely fine. The only thing you need to think about when price has passed the last medium-term peak, can I still structure a clean setup? Is there a clean setup there? And obviously, do I have at least a minimum of 2 to 1 to the upside? Okay. Certainly, we want to be structuring trades that offer that greater reward to risk payoff. So TPM certainly does that and ticks all the other criteria in terms of price action. And blue sky territory is always very, very good. Next cab off the rank, SOL. This is actually one that should have appeared in last week's list. So somehow we missed that because last week we did actually have a higher high on this candle compared to the previous week, and we also had a higher low. The low there on that candle, 1566, and if I go to the previous one, the low there, 1565. So certainly higher lows and certainly clearly much higher highs. Should have been in last week's list. It wasn't. It did appear this week again. So how could we trade this particular setup? Can we structure an appropriate entry level and stop loss that still meets all our criteria? Well, first of all, price action. Absolutely. Last trough at or above second from last medium-term peak. Where are we in terms of history? So if we zoom out, you'll see that we're at all-time highs, which again is a very, very positive sign. Certainly since August, if we have a look at towards end of August, beginning of September, at this particular level, it really started to put on a lot of strength at that time, which is a positive sign. And look at all the white candles looking very, very, very sharp by comparison, and as a result, seeing really good relative strength. So if we want to structure this particular trade and we still want to get into this trade, can we make things work? Well, because we're in blue sky territory, we don't have any overhead levels of resistance, which is a good thing. We still need to place an on-stop order. We still want the stock to prove to us that it has sufficient legs to move in the upwards direction. Now, that last candle is not particularly the sort of candle that you would think that might lead onto a good trade entry. However, what you will quite often find is that once a pin bar is broken to the upwards side in this particular case, because that's more of a bearish pin bar than a bullish pin bar, once price moves beyond that level, anybody who was selling at that level realizes that perhaps that wasn't quite the wisest thing to do, and as a result joins the queue and jumps in line to bid the stock further and further in an upwards direction. So as such, we still need to place an on-stop order at this point because we have moved certainly well in excess of 0.5% above that last medium-term peak. We still need to place an on-stop order. In this case, the on-stop order is going to be 0.5% above the candle high. So that's the high of this last candle, the candle there, 1641. So an on-stop order 0.5% above that has an on-stop order at $16.49. With a limit to 0.5% above that, you can work out those numbers for yourself. And a protective stop, again, using your ATRs and making sure that you are at least 0.5% below that last medium-term trough, has a protective stop coming in at $15.42. So on the basis of that, you have around about $1.07 of risk on a $16.49 stock. In terms of percentages, well and truly around that 10% model that we often talk about, but still providing a good opportunity for upward gains given the level of risk as well. That's SOL. Another one that came up this week was Ardent Leisure. Interesting setup in this particular example because, again, we've had a new trough formed, and the last candle doing a little bit of work and actually moving beyond the last medium-term peak. So quite often you might think to yourself, well, look, that's already broken that level, so that's now a null and void trade. Well, certainly in terms of piercing that level, yes, it has done that. How far has it run? Well, it really hasn't run that far at all. And in terms of the structure, the last trough coming in well above the second from last medium-term peak. In terms of where our protective stop goes, well, using our ATRs, we need to make sure that we're taking that into consideration, that we're taking the price action into consideration as well. So if we do all of that, we know that we need to place an on-stop order 0.5% above the candle high. Now, the candle high came in at $2.85. So if we add 0.5% to that, we come in with the massive on-stop order at $2.86. Now, protective stop needs to go at least, as I mentioned, at least 2 ATRs away and below that last medium-term trough, 0.5% below that. So if we do that, then we'll end up with a structure of the trade that sees us risking around about 13%, which is not ideal. It's getting out there a little bit. But the other side of the ledger, the reward side, you might remember that we're really looking for targets of around 2 to 1. So this longer term peak here, established back in sort of October of last year, is at 349. So if we're looking at reward compared to risk, we've got a reward there of around about very close to 1.5 to 1 on that particular trade. So ideally, 2 to 1 or greater is better. 1.5 to 1, it's certainly better than 1 to 1. No doubt about that. And by the time that this starts to move up to this particular level, if you take this trade, then it's certainly going to be dragging your trailing 3 ATR stop above your initial stop by the time we get there. So it's not quite 2 to 1, but certainly a lot better than 1 to 1 into a longer term peak. So that's Ardent Leisure. There were a couple of others in the list as well, and I think I started halfway through. MVP, so working our way to the top, certainly in terms of price action, really very, very strong. Last trough, well above second from last medium-term peak. Last few candles, again, more bearish than anything, but again, if we get some price action where it closes above these pin bar highs, it certainly can lead to some fairly quick upward upside movement as well. So let's just zoom out and see where we are in the broad scheme of things. We're at all-time highs. How did we get there? Obviously, something is going on with this particular stock. Really good relative strength, particularly in light of broader market weakness. More recently, certainly moving up nice and strongly as well. At this point in time, all we need to do is place an on-stop order above that last medium-term peak, coming in there at $3.50. We haven't quite challenged that level just yet, so it's just your normal on-stop order. And so we're going to place an on-stop order 0.5% above that last medium-term peak. So that sees an on-stop order at $3.52 with a limit to $3.54. Our protective stop outside of 2 ATRs and a minimum of 0.5% below that last medium-term trough has a protective stop coming in there at $2.92. Now, in terms of, if we go through there and have a bit of a look, in terms of percentage risk on that trade, let's go through and work that out. So I'll just bring up the calculator and just to be thinking about these sorts of concepts. So it's $3.52. And if we take away our protective stop at $2.92, we end up with a protective stop of 60 cents. Okay, so 60 cents is a fairly broad stop when we've got a $3.52 entry level. And that's a risk of around about 17%. So that's really getting out there. Okay, so it's not typically one that we would put in, by virtue of the fact that it's just a very wide stop. But having said that, 17% risk in terms of change in price. If we go down to our value line there and have a look, you'll see that 2 ATRs, or a single ATR, is 23 cents. 23 cents. So we're not quite we've got a risk of 60 cents, so we're not quite out at 3 ATRs. So it's a little bit less volatile than the previous stock that we had a look at that had an initial stop of around 3 ATRs. So all that means is that this stock can move a lot more, in comparison to other stocks. It does need to do a little bit more work to get to at least a minimum of 1-to-1 or at least 2-to-1. But the fact that this is a more volatile stock basically means that it's got a better chance of moving that distance compared to something that has a lower volatility. So hopefully that makes sense along the way there. Typically, we would prefer to see stocks around that 10% risk, plus or minus. But again, by virtue of the fact that it's a much more volatile stock, and certainly over the last 12 months, its volatility has increased as well, and hence, whilst a nicely structured trade in terms of price action, just accept the fact that this is a more volatile stock, and that's just something you need to think about, whether that's something that you're comfortable having in your portfolio, if you've got space for it at this point in time, given the overall level of market risk. We'll go through to the next one. I'll just get rid of some of these value lines here. They're encroaching a bit and we don't need them. So I'll just get rid of those. In terms of structure of the trade on HFA Holdings, that last trough that's just been formed by virtue of last week's candle having a higher high and higher low. So short-term uptrend now, confirming that last medium-term trough, and that last medium-term trough well above the second from last medium-term peak. So price action looking very, very good. If we zoom out and see where we are in the broad scheme of things, well, where's the next major point of resistance, if you like? We've really got to go a long, long way back to October 2007 from that last significant what was a point of demand, which is likely to act as a point of supply on the way back up. It's spent a long time going sideways. It's now starting to move onwards and upwards. So those particular levels at this point in time, we've certainly had a first test of that level, that last medium-term peak, testing that level. So we only need to break that level now. And to do that, we simply need to place an on-stop order 0.5% above our last medium-term peak. So as such, we have an on-stop order at $3.03 with a limit to $3.04. Protective stop coming in outside of 2 ATRs and at least 0.5% below the last medium-term trough. That has a protective stop there at $2.67. So on that particular, again, if we think about the risk on the trade, we've got a risk there of 36 cents on a $3.03 stock. So let's go through and just practice the exercise. So we've got 36 cents, so 0.36 divided by 3.03, and it tells us that we've got around about 11.8%, so let's call it 12% risk on that particular setup. And that fits in with our general goals of having a risk around that 10% plus or minus a couple of percent either way. That's HFA. I think that was it from the Australian list. We might go through and have a look at what came out of the US over the course of the weekend. Two setups this particular week. J2 Global. In terms of price action, last trough coming in at or above second from last medium-term peak. So again, let's get the value line out and just make sure exactly. I'll just move that annotation down a little bit so we can see everything. So that last trough low, 71.98, and that second last medium-term peak coming in at 71.71. So that last trough coming in above that level. So in terms of our price action filter, ticking the box there, absolutely. Where are we in terms of all-time highs? Well, let's zoom out, and we are at all-time highs. So certainly a very positive sign for JCOM. Relative strength for a long period of time has been very, very good. Some short-term underperformance as the stock went sideways, which is pretty typical, but of late starting to put in a nice series of rising troughs. All we need to do is break past that last medium-term peak. So to do that, we need to place an on-stop order 0.5% above that last medium-term peak. So an on-stop order at 79.09 with a limit to 79.47. Protective stop coming in at $71.62. That's 0.5% below that last medium-term trough. That's JCOM or J2 Global. Next stock, UHAL. Well, let's go out and see where this one's been. Again, all-time highs. And if we just zoom out a little bit along the way there, you'll see that a number of points along the way where we've got all-time highs, all-time highs, all-time highs, all-time highs, breaking through all-time highs, all-time high, breaking through all-time highs, break through all-time highs, all-time highs. So this stock has been progressively over the last 3 years making all-time highs continually. So don't ever be afraid of buying all-time highs. You never know where it's going to end up. In terms of price action, that last medium-term trough you can see clearly above the second from last medium-term peak. So really strong price action, good relative strength. And last week, nice strong candle, increasing relative strength compared to the broader market. So that's, again, another tick in the box as well. So all we need to do at this point in time is place an on-stop order 0.5% above that last medium-term peak. The high there, 414.13, so 0.5% above that level sees an on-stop order at $416.20 with a limit to $418.27. Protective stop at least 0.5% below the last medium-term trough and outside of 2 ATRs as a minimum. And the protective stop coming in there at $382.82. That's UHAL. Let's go through and see just roughly what the risk is on that in terms of percentage. 416.2 less our protective stop of 382.82. So we've got a stop distance there of $33.38. If we divide that by our entry level, 416.20, and we have a risk there of around about 8% on that level. So again, ticking all the boxes in terms of the risk on that trade as well. That's UHAL. That was it out of the US for this particular week. Let's go through very quickly and we'll have a look at the open trades in the watch list at this point in time. It's always good to go through, even though you may not necessarily be in any of these stocks. I think it's important to understand the role of a trailing stop in terms of exiting and helping you to accumulate profits over a period of time. ACGL has been one such trade that has continued to move higher and higher, and our trailing stop rules has meant that as of last week, up at around the $78 level, in terms of risk to reward, we were getting close to 5-to-1 on that particular trade. So again, even though end of August was a pretty diabolical period on the markets, certainly there's still been quite a number of stocks that if you've had them in your portfolio and you've been able to stick to your rules, that they would have certainly repaid you fairly handsomely along the way and helped to make up for any losses to the downward side. That's Arch Capital. We'll just go through and have a quick look. Bio-Rad at this point in time, just starting to move back up. You might remember we pierced the initial trailing stop, and as I said, meaning that we're going to have a hard stop all the way down here, and if it happened to get triggered, we were going to end up with a significantly greater loss on this trade than initially anticipated. It has since then started to move up in the upwards direction. So that's at least one saving grace for that one, BIO. Casey didn't do too much last week. Certainly that trailing stop still flat at the moment. Same with CHD as we start to go through there. Cintas Corporation. Flat from last week, but certainly still showing really good relative strength for a period of time, even though we did have that bout of volatility at the end of August, moving in the right direction. Cytec Industries, that's part of a takeover at this point in time, so that's all the premium in that. Docs, previous week having a very strong candle. Last week, perhaps not quite so. Just needs to close a little bit higher to drag that trailing 3 ATR up. Domino's Pizza, series of succession of lower peaks at this point in time, although we do have rising troughs, so we're really in what we would call stagnation mode. We just need to get a bit of a move on to the upward side for Domino's. EFX, last week, bit of a doji there, not really doing too much in by way of actual strength last week, so no change to the trailing stop on that. FISV, another higher close, dragging that trailing 3 ATR upwards again, and has rebounded really strongly since that bout of turmoil at the end of August. That was a trade from the previous couple of weeks that closed below its trailing stop. Global Payments, again last week, putting another higher close and just dragging that trailing 3 ATR up as well. I know a couple of clients who are on that one, so that's good news. ISBC, last week, certainly moving towards the upward side before getting a little bit of weakness towards the end of the week there. JAH, that was one from a couple of weeks ago. I'll have to take that out of the watch list here. Lennox International, taken quite a long while for this stock to get out of this sort of erratic sort of sideways movement. Big swings, obviously, fairly volatile in its movements, but starting to move up. It never closed below our trailing 3 ATR, went close on this particular occasion. Sticking to your guns, it's moved up higher and is now starting to drag that 3 ATR with it as well. So looking very positive along the way there. That's Lennox International. And you can see my Beyond charts just struggling there a little bit. Manhattan Associates, again, a lot of volatility through here, starting to move upwards. Previous week, very, very strong. Last week, look, not a candle that is too much to be afraid of. Certainly, clearly seeing some support at the bottom end of that particular candle. It's had a very strong ride up, so perhaps due for a little bit of a pause before moving up further. Macy at this point in time, a little bit better candle than the previous week, a higher close, but still certainly you can see symptoms of supply overhead there. So really in this tightening formation with lower peaks and higher troughs. That's Massey or Massimo Corporation. And again, Beyond charts just needs to get a little bit of a reel on. There we go. MKTX, Market Access Holdings. Nice candle there last week, particularly when you blend those two candles together. Certainly getting close to all-time highs here. A higher close at the end of this week would just about see that 3 ATR trailing stop move to the upward side as well. So that'd be a very positive sign. MTN, Vail Resorts, a nice close last week, higher close, and as a result, dragging that 3 ATR upwards. A nice sign. Omnicare, that's one that's been there for a while. Volatility is really sort of drained out of that at this particular point in time. And really not a lot of net movement. I'll have to go through and check out the fundamentals on that. That may be under takeover or something like that, given the lack of real directional movement in that. Orly certainly has been one in the portfolio for a period of time. Really strong candle last week, moving onwards very, very, very strongly. Really nice higher troughs now. All-time highs, and it's been all-time highs for quite a period of time. And this is, again, if you reflect and think about your previous experiences with trade management, this is a stock that you could have clearly been in from anywhere around the $120 level. We've got beautiful high troughs all the way through. There's a trough that's higher than second from last medium-term peak. We've got points of supply through here, breaking through. Certainly a trade entry of around about that $100, and did it ever close below a trailing 3 ATR? No, it didn't. And now, that's a couple of years ago, but in spite of all that, going from $100 to $276, not once closing below that trailing 3 ATR despite all the market volatility. And you only need one of these in your portfolio to make a massive difference to the whole situation. So that's what good trading and investing is about, folks. And you really just need to keep it as simple as possible. Q-Link, that went out of the watch list the previous week with that big candle closing below that trailing 3 ATR. And that's the good with the bad. So occasionally you will get big moves where you donate a lot more than what you expected to by virtue of that rule. But in many cases, as is the case here with Starbucks, big move down, a big move back up. At one stage during the week, price all the way down, looking very, very dark and very, very sad, closing back above, a very strong sign, and moving onwards and upwards. So you do get the good with the bad. I think over the longer term, you'll end up with a net significant benefit by using your soft stops, particularly in the lower volatile markets. And again, it's something that you might consider, that when you see the volatility increasing in the markets, whether or not you wanted to you start using hard stops, you could do that if you wanted to. The choice is up to you. But for the purpose of the watch list, I will continue to use soft stops all the way through. Starbucks, even I think it was with earnings last week, still holding up very, very strongly. And at this point in time, in terms of initial risk on the trade, getting close to 2 to 1 on the results of that at this point in time. Getting close to the end of the US watch list here. At one stage earlier in the year, there were around about 90 open trades in the US watch list, and obviously with the market volatility, particularly during August, we're down to around about 40, 45. It's certainly taking a while to build that list back up again, and that's because of the lack of appropriate price action. And as we said, it was going to take a while for that to start establishing itself again. Sorry, Dental Systems, last week, doji, nothing really happening there at this point in time. The one thing you've got to consider with the US market, just having earnings coming out on such a regular basis, it just makes for that increase in volatility by comparison with the Australian stocks. TSS continuing to move upwards, nice higher close last week, a little bit of evidence of supply coming in, but still dragging its trailing stop upwards. TWC, not a lot happening last week. We've got a series of lower peaks but rising troughs, so really just sort of squeezing at that point in time. And if we can get a degree of demand coming in, then that may well push up strongly to the upward side. VMC, a little bit higher close this last week. Again, we've still got this sort of squeezing type of formation happening at this point in time. It needs to just decide which way it's going to go. Some evidence there that looks like it, the last week's candle, that it might be starting to move to the upward side. WDFC, interesting looking at this as to could have actually appeared as a new setup again for this particular week. It didn't come up on the scans, interestingly. Certainly, whilst you do have $100 there at this point in time, showing the fact that we've got some, clearly some very strong price action, nice shallow retracement moving onwards and upwards. Certainly, you could have a look at that as another opportunity to enter WDFC. You can go through there and do the sums yourself. WSO, volatile week last week, price coming all the way down below its trailing stop and closing well above it. Hence the value in using a soft stop as opposed to a hard stop. Time will tell. Our job is just to manage the trades accordingly. ULTA, you'll see the volatility during the end of August. Now starting to put in higher troughs along the way. Nice, strong candle last week as well. So showing certainly some good price action on that one. POST, a bit better week last week, and certainly needs to start moving onwards and upwards to drag that trailing 3 ATR to the upward side. WTM, White Mountains, a bit of a doji last week, not much happening there, but going in the right direction. NVR, last week's candle, a little bit bearish, but certainly, in the scheme of things, the odd black candle along the way when you've got lots of white ones. There's nothing to be too concerned about. PGR putting in a bit of a pin bar there in the opposite direction. Be interesting to see whether or not whether there was a price volume volatility signal or not. No, there wasn't. So certainly be interesting to see what happens when price gets towards the upper side of that candle wick there, and see what happens then. Getting close to the end of the list here. AIZ, more recent one there, just triggering in a couple of weeks ago, putting in a pin bar last week. Certainly testing the downside, closing up near the highs. Certainly a positive sign for that stock, AIZ. EXR, triggering a couple of weeks ago, bit of a bearish candle last week. Still got a bit of work to do on that one. And AAP, this was one that triggered last week. It was, and you'll see there that white candle there triggering the order in, and being quite a nice candle as well. And as a result, it's starting to drag its 3 ATR upwards. Still got a bit of work to do before it takes over from the initial 2 ATR based stop, but certainly moving in the right direction. We'll go and have a quick look at what happened in the in the Australian watch list this week. Capilano, certainly the volatility has increased on this stock. Very sideways movement. Then once we got into the trade, took a little while, and then started to really reap dividends along the way. Still hasn't closed below its trailing 3 ATR. There's been a number of price volume volatility signals along the way, and certainly these levels up here in terms of your initial risk on the trade. You know, a $2 risk on the trade, and going from $12 entry level up to $24. That's a fairly sizable type of move in terms of that. So a $2 risk giving you $12 upside. That's a 6R return on any of those, a number of those price volume volatility exits along the way, or certainly on the highest ones. Some of those low ones giving you around about 5 are on the way. And so even if you did take half off the table at those levels, you're still in a stock that's trading well above its trailing ATR at this point in time. That's Capilano Honey. Auckland International Airport, certainly last week was looking very, very strong during the middle part of the week, and then price coming back down, but still the ATR nearly coming up now to the initial entry levels. And again, this is a stock that you could have actually been in for a couple of years and had a really terrific run out of this out of that stock. So again, just good trade management is what it's all about. ARB, after going sideways for what seems like an eternity, really nice candle last week. At this stage, not quite dragging that 3 ATR up at this point in time. So whilst we've got a higher close, it just means that hasn't dragged that up yet, because the volatility, if you like, is still quite large. So another strong week this week, or a slightly higher close, should start to see that now start to extend, and as a result, given that the volatility, if we don't have a significantly large candle adding to volatility, then I think you'll find that will, as a result, drag that little green line, your trailing 3 ATR stop, in an upwards direction. BWP, at least it's moving in the right direction. We've got slightly higher troughs, but still lower peaks at this point in time. It looks like we're going to get a higher peak now that we're trading past this last medium-term peak. Moving in the right direction, a little bit of relative strength coming through. That one's taken an eternity to really get its mojo happening. GHC, a couple of inside candles the last few weeks, really not too much doing there, nothing to do if you're in that. Just be patient along the way. GOZ, again, if you're in this, just be patient. At this point in time, we're a little bit below where we got in. It's taking a little bit of time. Certainly some clear signs of demand below these levels. Price has come down and started to move back up. So we can see that we've got this level of support here. It's just that we've got the supply levels coming in overhead as well. And so still being squeezed at this point, GOZ. James Hardie, bullish sort of pin bar there. Only better pin bar than that would be to have a white body, but certainly moving in the right direction at this point in time. If we do get an interest rate cut, then that's certainly a stock that should benefit from that. AZJ really going sideways at this point in time. Certainly at least some white candles through here intermittently. A black candle there. Would be nice to see this starting to move towards the upward side. Beyond charts doing a few strange things there. AHD continuing, a nice, strong short-term uptrend there, medium-term uptrend. By the looks of it as well, even though we had a little bit of lower peaks through there. That's AHD. APE, nice candle last week. Has been going sideways over the last several months. Looking quite strong at the moment. And certainly looks like it's ready to start moving higher. So if you've been in that, certainly be patient, stay with it. That's your job. Little green line tells you when to get out. That's APE. MNF. This is one that during this week, I think it was. It might have been Monday, where it actually came down and triggered its hard stop. So that was one that from the word go really just struggled and has finally death by 1,000 cuts on that one on MNF. BKL, last week China introducing a revision to their one-child policy, and as a result, Blackmores experiencing a huge move up during the course of the week. So if you notice this and you happen to see $200 and you're a holder of that and saw that as an opportunity to take out, I wouldn't blame you, given that the return on this trade from what was initially around about a $10 risk at entering at close to $80 and going up to $200. That's $120 on your $10 risk. That's a 12 bagger. So absolutely, if you happen to be watching this during the week and you got you took off some of your profit or you closed all of your trade at that level, then I think that's absolutely fine. Whilst it doesn't meet the end result of getting out once price closes below, certainly taking a 12-hour profit, never to be blamed for taking a profit in that situation there. Certainly there's been some price volume volatility signals on Blackmores along the way, but the one-child policy in China is no more, and as a result, the demand for infant formula, milk products and those sorts of things will certainly go through the roof, and that's why Blackmores spiked up like that. They've basically got a partnership or a deal with Bega Cheese, I think it is, to help produce infant formula. Some of the other stocks, I think it might be Bellamy's, I think is one that produces infant formula, and probably given that the New Zealand economy is based largely on dairy, I would expect to see stocks that are in that part of the market benefiting from that over the next few years. There's me talking all fundamental. Blue Sky Alternative Investments. There's one that triggered from the previous week. Nice candle as well to enter us into that particular trade. Good relative strength, despite the fact that having a fairly wide stop as a product of its volatility. And again, you'll see the ATR lines here over a period of time increasing along the way. So just showing that this stock is becoming a little bit more volatile, and as a result, that wider stop. So again, whilst ideally during a low volatile market, that's when your investing and trading is typically a little bit easier, and you'll have stops of around about 10%. As volatility does increase, expect to see still well-structured trades, but with slightly wider stops due to volatility. And CKF was one that triggered in from a couple of weeks ago. So nice strong move up last week, certainly not the best of candles, but still moving in the right direction as well. That's CKF. And again, with that a little bit of extra volatility in recent times, a little bit wider stop than normal. And that's about it from the Australian portfolio. So, folks, again, apologies for the technical issues earlier this morning. I'll go and get this all once the recording has finished. posted. As soon as it is posted, I will send out an email to let you know that it's available, and the Watch This should come out shortly after lunchtime today. All right, that's it for me. Thank you for listening. As you if you're taking today off, have a good day. Those of you who are in Melbourne, the rest of you on Cup Day, I know a lot of people have Cup Day parties and things like that in the afternoon. Don't bet too much. Perhaps if you can bet on one thing, maybe bet on, or at least keep your fingers crossed for an interest rate cut from the RBA. That would be good for everybody. All right, folks, we'll catch up with you very soon. Bye for now.